Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Here's the latest. Kamala Harris and President Biden are set to speak in Maryland today. It is their first joint trip since Biden dropped out of the race. This coming ahead of Harris's rally in North Carolina tomorrow, where she's expected to unveil details about her policy agenda. Joining us now is Tom Steyer, co-founder of Galvanize Climate Solutions. Tom, great to have you back. Thank you so much for being with us. What are you hoping to hear from Harris's campaign, given that we haven't heard so much in terms of how she differs from President Biden?
Well, what I'm expecting to hear, Lisa, and hoping to hear, is that her agenda around the economy is going to be about opportunity. That, in fact, she understands that America is the land of opportunity and it gives everyone a chance to do the most. And that is exactly what drives this economy, what makes our capitalistic economy so strong. At the same time that I expect her to continue most of the policies of the Biden-Harris administration.
So she will continue on this electrifying the grid. What more do you expect, if she were to win, that they can add on to what Biden did when it comes to the Inflation Reduction Act?
Well, I think to a large extent it is going to be about implementing the Inflation Reduction Act, which is really two things. It's not just about the grid. It's about deploying the existing technologies, wind, solar, batteries, EVs, but it's also about innovating and creating the next generation of energy-related companies and technologies. So that second part is absolutely critical. We're seeing deployment happen spurred by the IRA, but very much driven by private money. What we need to see is new companies solving some of the problems around energy in ways that work for consumers and companies.
But when it comes to that competition, and if you think climate is existential, why not let the cheap Chinese EVs into the United States? How does Democratic Party square that?
Here's my answer for you. Look, I am a huge believer in trade. I believe that the benefits, the dispersed benefits to American consumers of trade are huge and important, and we've all enjoyed them for a long time, and it's theoretically true too. What is true is that the Chinese economy is doing something strange. They are leading the manufacturing of almost every clean energy product: wind turbines, solar arrays, batteries, EVs. But what's also true is they're by far the biggest polluter in terms of carbon emissions. And they're using their carbon emissions to try and drive their economic program of leading this energy transition to pull their very weak economy out of the ditch. So in fact, the idea that they should be charged for their emissions that are about a third of global emissions makes very good sense to me. And we're doing it in a not direct way, but it's actually a way that turns out to be pretty fair.
The other big issue, not just national security when it comes to China, but the other big political issue in the election is who's going to win the union vote. How does Kamala Harris strike that tone with the fact that they want to see more EVs on the road, but actually this unnerves a lot of rank and file of those labor unions in places like Michigan, which is critical to Democrats maintaining the White House?
Absolutely, but let's take a step back if we could, Emery, which is this. We've all listened to Elon Musk and Donald Trump talk about their attitude towards organized labor and labor unions. In fact, they've been sued over what they said on Twitter. So the truth is, it's not a choice between Kamala, who is a very strong union person, and a blank person. It's someone who clearly is anti-union and anti-working person. And that's been a long history over decades of where Mr. Trump has gone and where he's likely to go. So yes, it's absolutely clear that Michigan, obviously the UAW, has a huge sway in Michigan, and they're a really important part of the Democratic coalition. But the truth is that the person who supports working people and who supports organized labor is definitely Kamala Harris, and to go any other way is to ignore the facts of this week, let alone the last 2 decades.
And Tom, you're painting quite a dichotomy between the two candidates. And I just wonder, in your conversations with not just investors, but portfolio companies that want to do clean technology, if there's a sense that they're holding back on investing because of the uncertainty of the race, and they might continue to do so if it is a Trump presidency.
Well, I think when we talk about the possibility of a Trump presidency, let's break it down into 2 things. One is what's going to happen in the United States of America. And I think that to a very large extent, when it comes to the deployment of the existing technologies, they're just cheaper. If you look around the world last year, so 2023, of new electricity generation, 86% of it was renewable. They're not doing that to be nice. They're doing it because it's a cheaper, better deal. And those lines have crossed, and there's nothing that Mr. Trump can do to change the economic forces. What is really important from the standpoint of addressing the climate crisis more broadly is this. This is obviously a global issue. It requires global cooperation and American leadership. That is something that a Trump administration will never do. I mean, they famously withdrew from the Paris Accords. He's talking about getting out of NATO, let alone cooperating with the UN efforts around climate. So from the standpoint of the American economy, we're going to continue to deploy. I think that's baked in the cake just because it's a better deal. Texas has tripled its solar since 2018, and that's the state where they love to say how bad renewables are. But they're a bigger wind producer and solar producer than California.
Tom, we just have about 30 seconds. Do you think that Musk's friendship with Donald Trump will ensure that there will be a friendly environment for electric vehicles even if Trump gets into the office?
No. I think that Mr. Trump doesn't really have policies and he doesn't have friendships. So whatever he said this week, that's something that'll change over time because they don't even have a platform. They literally don't have a platform because they don't have policies. They just have instincts, urges, and vengeance.
Tom Steyer of Galvanize Climate Solutions, we really appreciate you coming in, as always. Thank you for being here. Here's the latest. Cruise lines bucking the trend in travel industry. The signs of a consumer slowdown continue to mount, at least in certain corners. Norwegian Cruise Line Holdings, Carnival, and Royal Caribbean all boosting their year-end outlooks amid record-setting demand. Harry Sommer, Norwegian Cruise Line Holdings President and Chief Executive Officer, joins us now. Harry, thank you so much for being with us. I want to just start with what you're seeing in terms of whether demand is sort of plateauing, accelerating, or falling off. Just a touch on the margins.
Well, good morning, and thank you for having me on. Demand in the cruise industry right now is great. We're very, very happy with what we're seeing with the consumer. Keeping in mind that the demographic that we're pursuing is mostly upper middle class, upper class demographic across our 3 brands. And those consumers certainly continue to have money to spend and are continuing to spend it on cruise vacations.
At this point, Harry, I guess there's this key question of how divorced the upper echelons are from the rest of the economy. Essentially, do you find that your business is somewhat insulated from a cycle where you have consumers that aren't necessarily feeling the same kind of pinch as elsewhere?
So I think there's a number of criteria, a number of things that really do help insulate us, as you mentioned. Number one, we are fishing in the upper demographic pool, as I mentioned, but we also have a very long lead time for bookings. So unlike hotels and air, which are dependent on a lot of close-in bookings, our average booking curve is 6-8 months into the future. So we have tremendous visibility into trends. If there is ever any weakness, and we're not seeing any, but every once in a while there's a few sailings that perhaps are doing less well, we can make adjustments 6-8 months in advance, small adjustments that put things back on track. It's really a unique feature of the cruise industry that allows us to continue to have more stable and higher returns. Fundamentally, cruises is a tremendous value. Our average yield, versus a hotel ADR is anywhere from 30 to 40% below what they'd spend on a hotel. And I think consumers, whether times are good, but especially if times are less good, certainly recognize that value, and that accrues to us. I mean, the last couple of quarters, we've reported 8% and 6% year-over-year yield increases compared to last year, where we're guiding to another 6% for Q3. We see that as a very strong consumer.
Harry, I just wonder about prices. I mean, are you in a position where you might even be able to raise prices given that level of demand?
I think, yes, great question. I think what we've shown in our financials for the last few quarters is pricing has been going up. We're guiding in Q3 and Q4 for prices to go up. I mean, you may imagine, with the long lead time I described, Q3 and Q4 are substantially sold out. So we have great visibility, and we stand behind the guidance we just issued a few weeks ago in our quarterly earnings call. Pricing will absolutely go up in both quarters, and it looks that way for 2025 certainly as well.
Harry, I want to get your thoughts as a CEO of a major company. Lisa mentioned this fascinating statistics of CEOs being let go from companies at an unprecedented pace going back to 2017. I wonder how you think about this moment in time. You're obviously the CEO of a company that's successful, but when you look among your peers, again, not just the cruise industry, but CEOs of large companies, has something changed that there is more pressure in a way there hasn't been before?
So I'm guessing there's always been pressure in the CEO role, but I think we're in a world of a rapidly evolving consumer. Tastes change over time, and consumers change over time, and we have to be constantly thinking and innovating in the future. I mean, right now, as an example, we're planning for ship deliveries through 2036. I mean, we have to have a pretty good crystal ball and a pretty good feel for what the consumers are going to want for, years, even a decade into the future. And it's really important to keep that future focus if we're going to be successful.
Harry, we had the CEO of Marriott on yesterday, and they're talking about Marriott yachts now. Are you concerned on the higher-end consumer, the competition that's coming into the industry?
I've always said that our competition is not other cruises. I mean, cruises in general make up about 2 to 3% of the overall vacation market. We're keenly focused on what hotels do in general. And we believe cruising is a wonderful vacation alternative to hotels. I mentioned before the huge gap in value. We're priced 30 to 40% below a hotel. But also, hotels have their asset-light model as being a competitive advantage in their industry. It's also a competitive disadvantage because they lose control of the product. We own all 32 ships in our fleet, fully own them, 100% ourselves. We have 13 more ships on order, by the way, and we can ensure that we deliver an outstanding, consistent product across the fleet. And I think guests are beginning to realize that consistency is something you don't always get in the hotel space.
I've been on cruises before. Then when you get on board, all the extras you have to spend more on, especially things like some of these excursions. Are you seeing consumers start to ratchet back some of that spending?
Not at all. Our onboard spend continues at record levels. We get weekly reports, as our ships travel of our 55 to 60,000 guests that we're carrying at any given time. Onboard spend shows no cracks. We're very, very happy. It's another advantage. I mentioned the long lead time that consumers have in making bookings. So they're paying for their cruises 4 or 5 months in advance. By the time they come on the cruise, that money's spent. It's already paid for off their credit card. They come on the ship with the full wallet ready to spend more. And unlike hotels, where people don't really stay at a hotel other than to sleep, people stay on the ship to do everything: shop, spa, casino. They arrange their shore tours for us. So we really get a much larger share of the consumer's wallet on the ship as well.
It is literally a captured audience. Harry Sommer, thank you so much for being with us. Harry Sommer, Norwegian Cruise Line Holdings President and Chief Executive Officer. Bond market selling off a bit, yields higher. You are seeing good news is good news across the equity sphere. Joining us now, Tom Porcelli of PGIM Fixed Income, which is a good and beautiful thing. Tom, always wonderful to see you. Thank you for being here.
Good to be with you all.
So what's your initial take? This actually wouldn't suggest that the Fed is behind the curve and needs to cut rates aggressively.
So I think it depends how you define behind the curve, right? Because I don't know that you're supposed to be looking for notable consumer weakness today. Let's just use the sort of the Fed's own forecast against them for a second. If you look at what they're forecasting for the unemployment rate next year, what they're forecasting for inflation next year, and what they're forecasting for the Fed funds rate next year, the unemployment rate and the inflation rate we have that right now. and they have 100 basis points of cuts next year. So I would argue that you've pulled forward all of this. You've pulled forward the slowing in labor. You've pulled forward the slowing in the unemployment rate. So I think there is justification for pulling forward this 100 basis points worth of cuts that they actually are forecasting for next year to this year. So to me, that's the sort of the right calculus of it. I would actually also argue that, when you think about cuts, even if, and again, it's not our forecast. We're not saying they're going to do 100 basis points worth of cuts, but I have a lot of sympathy for the idea, which is what the market is pricing in. I think what we have to keep in mind is even at 100 basis points, if you cut 100 basis points, the Fed is still restrictive. I mean, that's sort of the interesting thing. Policy was calibrated or is calibrated for a meaningfully higher inflation rate and is calibrated for a meaningfully lower unemployment rate. But those things have now moved.
Okay. That said, you have to wonder if this is incredibly restrictive, why the economy isn't feeling it, why you're seeing an acceleration in retail sales.
Yeah, so what I would say is that there have been so many buffers in place, right? Like if you think back to how this whole thing started, all that fiscal stimulus, all of that excess saving, the idea that there was a wealth effect because home prices were rising a lot, equity prices were up a lot. This made people sort of exist in this feel-good environment, and I think that really sort of propelled consumption in so many ways. So I would argue that the hikes that we saw, that aggressive tightening cycle, really didn't have a chance to sort of clamp down because of all of those sort of extra factors that were in play. But I would highlight that you are starting to see delinquency rates on the rise. Modestly, but they're rising. You are starting to see the unemployment rate rise. Again, it's still relatively low, but it's up 0.7% at this point. So I think you're starting to see some of the tight policy now start to show through.
Well, it's this idea that you're not cutting to react. You're cutting just to get us in the right place.
Yeah. That's
when
right.
you think about rate cuts, what even is that line? Because I know you're saying just with the Fed's projections, 100 makes sense.
Yep.
Or is the idea of cutting 100 basis points something that looks like a recession? Where's kind of that cutoff for that level?
Yeah, I think it's such an important idea. And that's why I think, and I've said this before, I think when the Fed starts cutting, I don't think, classically when the Fed starts cutting, it's like, it's over, right? The recession is here. I don't think that's what this is. I think the narrative coming from the Fed has to be, hey, look, we're just looking to extend the cycle, right? We're looking to extend the expansion. I think, so the Fed has a real opportunity here to sort of shift the narrative. And I would argue that they're starting that process now. When Powell finally shifted to focusing on labor over inflation, which I would argue was long overdue, I think that's step one. And I think the next step is, hey, look, we don't think that things are really sort of slowing in a notable way, but we recognize that policy is calibrated for a completely different inflation regime than what we have right now. And so we can take back some of that aggressive tightening.
Well, Raphael Bostic is certainly one of those individuals that is starting to recalibrate. But if that's the case, and they're going to message that this isn't a deterioration, but we're trying to land the plane, how do they do that before the U.S. election?
So I love this question, and I have we've done this analysis, as I'm sure so many others have. We went back, and we just went back to 1984. It seemed like a fine round number. We looked at every single election from 1984 through to today, and what you see is that history, that modest history, is littered with examples of the Fed adjusting policy during election years. In fact, not just during election years, but in and around the election month. All they needed was the justification from a data perspective. And I would argue that the unemployment rate being up as much as it is, inflation being down as much as it is your justification.
How do we know, though, that it isn't actually headed in the other direction, that we already saw the slowdown, especially because jobless claims are actually going down? And you're seeing, for example, Walmart increasing its expectation for profits. You're seeing companies actually doing better out of the 493 other than the Magnificent Seven and accelerating earnings. How do we know we're not at the precipice of an acceleration that will only be turbocharged by rate cuts?
So it's again, a super important question. And what I would say is Walmart is maybe the exception to what's going on broadly, right? Because we know from a lot of other retailers that things are starting to feel some of the pressure of a consumer that's really looking around for value. And if Walmart's really the value player, then it actually makes a lot of sense that they performed well. And I didn't look at the numbers directly today, but I heard that they did pretty well. So I think that is an important idea. But again, I think this is exactly my point. I think let this continue to roll out, right? Let the economy continue to sort of expand by just removing some of the aggressive tightening that they have in place. I don't know that unless you think that inflation is going to reaccelerate to, 4 handles, which is what this policy is calibrated for, I think the Fed can feel very comfortable that all they're doing is taking back some of the aggressive accommodation that we don't need anymore because inflation has slowed so much. And sorry, Lisa, I'll make this one last point. Just keep in mind when we think about inflation, just think about how labor is doing. The unemployment rate, again, I hate to say it again, but the unemployment rate is up. But in combination with that, hours are down. I think Mike mentioned that earlier, but that broadly speaking, hours are down a lot. Wages are down a lot. Quit rates are down a lot. The consumer's not feeling that great about labor right now. And if you think about the thing that really does the driving from a consumption perspective, it is the unemployment rate. The unemployment rate rises and consumption tends to slow.
Just quickly here. Yeah. What would you have to see in the non-farm payrolls report in September to change your view?
So I think that you need a dud of a report, right? I don't know how you quantify dud. I fully acknowledge that. But I think you need a number that really sort of, that has even worse contours than the one that we saw last report. And I think if you get that, I think that's the Fed's justification for going 50.
Tom Porcelli of PGIM Fixed Income, always wonderful to see you. Thank you for being here.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.